When we look at PPI, give me a sense of how much import it should have for investors trying to gauge what's going to happen with the Fed.
Good morning. Thank you for having me. So the PPI is of interest because some of its components feed into the PCE, which is what the Fed targets. So we know the CPI was very hot for January. We know a lot of that will feed into the PCE, but not all of it. So the remaining pieces of the puzzle, a lot of those come from the PPI. Examples would be healthcare, financial services, airfares. Those are the things that we'll be watching for.
And does it take on more importance, or get more of the spotlight because of what we saw with CPI?
Yes, for sure. The CPI was really far too strong for the Fed's comfort. So the question is, will the PCE be a little bit too strong or rather strong, right? That's what we're watching for with the PPI.
But then we're getting mixed signals a little bit because we saw weaker retail sales numbers coming in.
Yep.
What do you make of that?
So there were some distortions to the retail data for January. We had flagged that in advance related to seasonal adjustments, as well as there were big weather disruptions, right, all over the country in January. So I think that's part of the story. And then also the fact that while inflation is hot, that's on the services side. Retail sales, it's a dollar number, and it's measuring goods spending. Goods prices are still falling, and that's probably dragging retail sales down as well. But that's for good reasons, right? Not for bad reasons.
We heard from Atlanta Fed President Raphael Bostic saying that he doesn't think there should be any rush to cut rates. And he said that there's two key risks that the Fed has to grapple with. One is that rates remain too restrictive for too long. And the second one is that they might have this loosening and that inflation would remain stuck higher in spite of or maybe because of the loosening. What do you think the Fed is going to do, and how do they walk that fine line?
Right, so it's definitely a balancing act for the Fed. This typically happens around turning points in policy or weighing the risks in either direction of potential policy actions. We think the Fed starts cutting in June, and they cut at a pace of 25 basis points per quarter. So 3 cuts this year, 4 next year. It looks difficult maybe to cut right now after the January CPI, but we do have to remember that there's 4 more CPI reports between now and the Fed decision, and the January number could be a distant memory by the time we get to June, right?